Hi, my name is Nurhaliza binti Muhammad Amin to C5004. I will present Case 5 text for the CFO. Should Pfizer acquire allergan? Okay, we go to the issue first. On November 20, 2015, Pfizer, Frank D'Amelio, required to make a recommendation on whether to pursue or abandon merger negotiations with Allergan, a pharmaceutical firm with headquarters in New Jersey but tax residency in Ireland. Pfizer needed to make a significant move since its revenue had fallen in the previous 3 years. The stock price had remained unchanged and the investors were becoming irritated. The corporation needed a partnership that could boost their financial performance and status among the other global pharmaceutical companies. Because of Allergan Irish tax residence, this merger was both appealing and worrying. It gave Pfizer the options to cut its global tax rate. However, the U.S. Treasury Department recently proposed many regulations reform aimed at mergers that shift a company tax dominance to a low-tax country. Although the Amelio legal team avoided using the term tax inversions, the transactions that had many of the characteristics was the 512 billion price tax worth the tax saving. It was critical to determine both the positive tax savings from repetitive overseas income and the potential tax saving from future profit. The CFO needed to think about which assumptions were crucial and that anticipated tax benefit could still be available once the acquisitions were closed. Next, I will explain about the tax inversion. Tax inversion are transactions in which a corporation, in our instance Pfizer, becomes a subsidiary of a new parent company such as Allergan in other country in order to benefit from the low tax rate. Typically, U.S. corporations utilize them to relocate to countries that will have low tax rate. In theory, any corporations may do an inversion. However, public firms have a different long-term objective that private ones does. While both aim to improve shareholder value, private firm owners must be more concentrated with profit repatriations and possible exit alternative. These issues are less for a concern for public corporations that can continue to operate indefinitely. Even if a transaction is designed to acquire wealth overseas, when the cash is repatriated to its U.S. owner, it will be subject to tax. In the majority of circumstances, whether an exit strategy involves liquidation, dividend, or selling to another firm, such profit will be subject to U.S. tax. Next, on transfer pricing. Many American corporations employ transfer pricing to reduce their global tax rate. Companies exploit licensing and cost-sharing agreements to avoid or decrease U.S. tax after moving intellectual property to low-tax jurisdictions in other countries. Cash from international activity is then staged abroad until tax experts can find out how to send it back to the United States tax-free. U.S. multinational corporations' foreign earnings are taxed in the U.S., but only when they are repatriated. The transfer of offshore money back to the currency of the nation in which a firm is located is known as repatriation. Corporate tax are levied on repatriated profit when companies located in the U.S. create earnings overseas and choose to repatriate those revenue. So, risk in evaluating the deals, the agreement will have an impact on tax revenue in U.S. The U.S. Treasury Department may be considering changing the regulation governing inversion. This that decreased tax in this way, known as inversions, might be the source of contentions for the US Treasury. The squeeze meal might cause the deal to be postponed. A greater risk is that Congress seek larger rules change in order to assist American business completely. As a result, Pfizer may be forced to pay for one-time benefit. The unpredictability for the situation may have impact on the tax rate and probability for tax evasions. After the merge, there is a danger of integrations. Both are large pharmaceutical corporations. There is possibility for post-merge integrations in this agreement. Pfizer has 78,000 workers. Meanwhile, Allergan have over 40,000. The firm will also offer a variety of items and locations. Integrating the department and affecting the gross margin sustainability will be tough. So, the framework or theory that I use for this case is the cost-benefit analysis, which is a systematic process that business use to analyze which decisions to make and which to forego. The cost-benefit analysis sum the potential reward expected from a situation or action, and then subtract the total cost associated with taking the action. So the calculation for this theory, the possible tax savings for Pfizer might be determined using the case and information on Pfizer's sales as well as predictions for the next years. Using a project growth factor of 5.7% by 2020, consider the revenue of each year. The savings are derived using tax rate of 25% without the mergers and 18% after the merge. The net present value for the difference in tax before and after the merger is used to determine the deferred tax savings. The prospective tax saving value is calculating by adding all the value, taking into the account the NPV of the terminal value of the different NPV of 24.044 equal to 15.99 and 20.35 from the transaction for 42.77 billions. When we compare the tax saving to the premium cost, which is almost 30% of Allergan share price, 45.6 billion, the deal doesn't make sense because the cost outweighs the savings. So, for the recommendation, I would like to suggest to advise Pfizer is to concentrate on corporate profitability rather than tax cut. In order to do this in the long run, Pfizer must develop a long-term competitive edge. By doing an industry analysis using 4-5 force model, Pfizer may execute to generate competitive strategy. Pfizer can adopt a cost leadership strategy in order to become the industry lowest cost producer. By pursuing this strategy, Pfizer will be able to investigate new technologies, supply chain management options, and supply diversification. That's all from me. Thank you.